The Institute for Financial Literacy is a collaboration between MoneySense, the National Financial Education Program, and Singapore Polytechnic International. The Institute is the outreach arm of MoneySense. We conduct free and unbiased financial education programs for the public. MoneySense is Singapore's national financial education program, set up in 2003, and is currently overseen by MAS, Monetary Authority of Singapore, and MOM, Ministry of Manpower. MoneySense aims to help Singaporeans manage their money well and make sound financial decisions on their own. Understanding loans and credit. This is the third video in a series of 4. In it, we will focus on answering the question, how much debt can you afford? Debt ratios are a guide to help us know how much debt we should be taking on to avoid overborrowing. The first ratio is the mortgage servicing ratio, which is the percentage of your gross monthly income that should be used for meeting monthly property loan installments. It is recommended that this ratio should be less than or equal to 30%. The second ratio is the non-mortgage servicing ratio, which, as the name implies, is the percentage of your take-home monthly income that should be used to meet non-property related installments. This would include credit card debt and other loans, such as for cars, renovation, and education. For this ratio, it is recommended that it should not exceed 15% of your take-home pay. Even if your ratios are within the recommended guidelines, always aim to keep them as low as possible by not taking on too much borrowing. One overall ratio to try and follow is to keep your total monthly loan installments, that is, both mortgage and non-mortgage installments, to within 35% of your gross monthly income. You can use the calculators on MoneySense's website to help you. What is a credit bureau? It is an agency that collects and stores information on your credit history, such as loans, credit card applications, and repayment records. Information in credit reports is provided by the credit bureau's members, like banks and credit card companies. A credit report on an individual will also contain a credit score. A good score suggests that an individual borrower has been managing his debts well, making installment payments on time, and is in good financial health. Having a good credit score will make it easier for an individual to qualify for loans. What can affect your credit score? A number of different factors could affect your credit report, such as credit you have now, the number of accounts open or active that provide you with a credit facility. Recent credit, if you have recently taken multiple new credit facilities, especially within a short period, you may be seen as overextending yourself. Credit history. A longer credit history suggests that you are a more reliable borrower. Enquiry activity. Too many applications or inquiries may suggest that you are trying to take on a lot of debt. Don't apply for a new credit card or facility unless you really need it. Remember to always pay outstanding bills in full and on time to avoid interest charges and late payment fees. Always keep track of when payments are due and avoid having too many sources of credit. You can learn more about credit reports and credit worthiness from MoneySense's website. Some considerations before taking on more debt. Ask for the effective interest rate, or EIR, and understand how interest is being charged. Look for lowest EIR loans as far as possible. Ask for the full repayment schedule to know how many installments there are for the entire loan. Ensure that you are able to afford these installments after putting aside savings and meeting your monthly expenses. Make sure you read all loan documents before signing. Ask about key clauses, especially on interest, fees, and charges. Remember that every loan must be repaid in full, even if your personal circumstances change, such as if you were to lose your job or suffer a pay cut. If you are thinking of acting as a guarantor for someone else's loan, be aware that it is a serious and major financial commitment on your part. You will be legally required to pay off the borrower's debt if he is unable to. In addition, you may not be able to recover anything from the borrower. The lender can take legal action against you to recover any outstanding debts without needing to take action first against the borrower. You will also be liable for all legal costs and expenses incurred by the lender to enforce its rights under the loan and guarantee, including overdue and default interest. The debt you are guaranteeing may result in you becoming financially embarrassed if the loan is not paid. This will affect your ability to secure loans for yourself. Ask yourself first, are you willing to pay off someone else's debt, and can you afford to do so? If necessary, seek legal advice before agreeing to be a guarantor. Here are the key takeaways. To know how much debt you should take, use the recommended debt ratios discussed in this video as a guide. Keep them as low as possible and the total monthly debt repayments to under 35% of your gross monthly income. Check your budget before taking on new debt and make sure you can pay in full and on time. Consider carefully before agreeing to be a guarantor. Ask yourself whether you can afford to pay off someone else's debt